conservative in investing in equities than would have otherwise been the case if this hadn't been hanging over our head. So a conventional accounting will never pick up the loss that we suffered in that. It was called the Omni affair. And like I said, it had some, I'm sure it had many differences too, but it had some similarities. And, you know, it's distracting to have something like this that obviously there was some mix of mistakes. There's some mix of misinformation. All of that will have to get sorted out. Our best guess right now is that when it's all done, 10 years from now, 15 years from now, the $275 million will be our loss. That most certainly won't be the exact figure, but like I say, if there's any reason to revise that number upward, we'll let you know promptly. It is the nature of insurance that you get unpleasant surprises from time to time. Lowe's Corp bought CNA in the early 1970s, and just in the last few years there was a fiberboard settlement on a policy I believe that was written in the late 50s, and there was as I remember, $1.5 billion loss on something where the premiums were a few $1,000s. Geico has lost, as I remember, $60 million on a book of business that was written in the early 1980s where the total premium was less than $200,000. You know, how much of that is stupidity, how much of it is fraud, or who knows exactly, but you can get some very unpleasant surprises in insurance, and unfortunately this will not be the last one. It won't occur in the same place, it won't occur exactly the same way, but the nature of insurance is that the surprises are on the unpleasant side. It's not the kind of thing that happens when you're writing personal auto insurance or anything of the sort, but when you write business where the claims pop up 10 or 20 or 30 years later. I think we've got a claim at a small workers' comp company that we have that goes back 20-odd years, 25 years or so, and it's just popped up to life in the last year or so, and it costs real money. So it's a business where the surprises can come big and they can come late, and that will happen even with good managements, but with good managements you'll have fewer such surprises. Charlie?
Well, that was a marvelous question. And imagine anybody asking a question of how to get educated who knows how to educate people. It's the same way you educate the dog, by rubbing his nose in it. And generally speaking, that was a dumb error. That was an amateur's mistake. It doesn't mean that General Re is suddenly full of amateurs. It was a rare lapse, just as at Berkshire we think the Omni affair was a rare lapse. I don't think we've repeated it since, have we, Warren? I can't think of a single one.
But again, you know, we don't know that we've repeated it.
Well,
these things pop up later. No, the answer is we haven't repeated it.
Yeah. So, yes, it was a dumb amateurish error. These things do happen. We don't think it reflects a sudden lowering of the intellectual standards of General Re, which are probably the best in the world. It's just one of those things that does happen once in a while. And there's one good side to these things. It does make you more careful. It really refreshes your attention to get banged on the nose like that.
Yeah, and it remains to be seen where the costs of that will be borne, because the entire set of facts and what was committed to and all of that, it's not been resolved yet. In the Omni situation, we had significant disputes on the facts for some time, and we eventually recovered a fair amount of money that for a time it didn't look like we would recover. So you know, the final chapter on this is not going to be written for some time, but it was appropriate to set up $275 million as a reserve in terms of what we know at this time, and that number could go up. It could also go down depending on the facts that we discover. Zone 7.
My name is Mike Thiele from Summit, New Jersey. would you please revisit the question of share repurchase for Berkshire Hathaway? We have heard today your comment about the price of Berkshire having been inefficiently priced from time to time in the past. We know that there are now more shares outstanding, and I'm curious as to whether the buildup of cash is causing you to spend more time looking for investment situations where you're more comfortable on the 10-year outlook. Thank you.
The question of repurchasing shares, and I made that comment about it being inefficiently priced at times. At those times, it always seemed to us, and we were incorrect in some cases, it always seemed to us that there were other securities that were even less efficiently priced. When Berkshire in 1974 sold at $50 a share, I might have thought it was cheap. But I also was looking at the whole Washington Post company selling for $80 million when I thought it was clearly worth $400 million, and I did not think that Berkshire was as underpriced then as the Washington Post company was. And that has been true at various times when there have been times when I thought Berkshire has been underpriced or even significantly underpriced, but at the same time I was finding other things which I felt were even more attractive. And like I say, many times I was wrong. We would have been better off buying our own stock instead of buying the things that I was buying. But if we have money around and we think Berkshire is significantly underpriced, and we're not finding other things to do with money, it obviously makes sense for us to repurchase Berkshire shares. I think it's difficult for most companies in this market, even though repurchases are probably close to an all-time high, if not at an all-time high. I think it's difficult for most companies to be have a repurchase of shares make a whole lot of sense these days. I mean, I do not think they're getting much for their money because we don't want to buy those shares ourselves, and it's I'm talking about the stock of various companies in America. And yet companies are much more enthusiastic about repurchasing shares now than they were 20 years ago when they were getting far, far greater returns from repurchasing. We will always, it's an option that we will always think about, and we're unlikely to do it unless we think it's fairly dramatically underpriced, because it simply we would want a big margin for error in making that kind of a decision, that we would not want to buy a dollar bill for 95 cents or 94 cents or 93 cents. But there is some level where we would start getting excited if we didn't have other uses for the money. Charlie?
Oh, I've got nothing to add to that.
Zone 8.
Good afternoon. Wes Thurman from Stanford, California. You mentioned earlier about the power of the brands on the internet, and I really can't think of a better brand, at least in my name, as the Berkshire Hathaway brand. And I guess going forward, have you thought about ways to use the Berkshire Hathaway name, further on the internet to capitalize on the reputation you've built over the past decades? And,
yeah, I think that's a very good point, and it is something that could be of real value. It's already probably of some value to us with the brands that we're associated with. I mean, I do think that Executive Jet or the NetJets program associated with Berkshire Hathaway, that Borsheim's associated with Berkshire Hathaway, the Berkshire Hathaway Life associated with Berkshire Hathaway, I think those brands are enhanced by the association with Berkshire, as some of other brands would be. But I think that's got a long way to go. I think you're dead right on that the internet reinforces the necessity for trust in dealing with people. I mean, you're getting further and further removed from the face-to-face dealing where you can go back to the store the next day or look at the person who sold it to you the next day and get an adjustment or something of the sort. You're really having to place more and more trust in somebody you're never going to see. And I think you're right that that Berkshire Hathaway, if it behaves itself properly, can get a reputation for trust that will be far greater than that possessed by the average company, and that when we properly associate that with some of our brands, that those brands will be enhanced by the association. So I've thought a lot about what you're talking about there, and so have our managers, and it's something that we intend to capitalize on in the future. It's rather interesting. I mean, if you look at the companies that do business with people where there's no face-to-face interaction either with the company itself or some intermediary like a retailer or anything of the sort. I mean, you've got Dell Computer, and now you have Amazon.com, but Geico is doing business with now 3.7 million policyholders, and it'll do, before the year is out, it'll be close to 4.5 million and probably 4 billion, 8 or so of business with people that have never met anyone from Geico. They've talked to someone on the phone. But we are one of the largest companies in the United States in terms of doing business on a direct-to-consumer basis. We're doing it with people who on average are paying us $1,200 a year or thereabouts for a promise. So we have a connection that people that talk about the Amazons of the world, where people are buying X dollars worth of books, we have a much more direct connection with people who tend to renew with us year after year. That is based on trust. I mean, it's not based on the neighbor next door who they can go to if they have a problem. It's based on the fact they trust this company that's back in the District of Columbia, Washington, to perform in the future. And that's a huge asset, and it's growing daily. I mean, we are adding policyholders every day who are signing up with us, who have never met anybody from the company. And that already, I mean, it's a very big asset. It will be many times bigger, in my view, 10 years from now. The Berkshire Hathaway umbrella that gets involved in one company after another like that people trust. I mean, we can be in an awful lot of homes over the years, and as more and more business becomes done on an indirect basis or a direct basis with the consumer, the power of that, in my view, should grow, and we just have to be very smart about how we maximize that growth. Charlie?
Nothing to add.
Okay. Zone 1.
Hi. My name is David Zelker, and I currently live in Redmond, Washington, where I work for one of your good friends. So if I get into trouble for having taken a busy Monday off work, maybe if I give you a call, you could put in a word for me.
If it's without pay, we won't complain.
It's vacation, yeah. My question is about how you two assign value to certain intangibles that I know you look at when you value companies. Anyone who's read your writings knows that you look for great management and economic moats, as you call them, that enable companies to raise prices and margins. I'd like you to drill down with us and tell us what to you are the signs of great management and economic moats. Furthermore, do you try to put a dollar value on those management and moats and other intangibles when you value companies? And if so, can you guide us through your thinking there? And lastly, I'm interested in how you pick your discount rate. I'm actually an alma mater of yours from business school, and I learned a bunch of junk about beta too. But I read that you just assign the treasury rate, and I'm not sure if that's right, but I'd love you to talk about your discount rate, and I'd really appreciate as much detail about your thinking as you can give us.
Yeah,
Thanks.
We think in terms of the treasury rate, but as I said earlier, that doesn't mean we think once we've discounted something at the treasury rate that that's the right price to pay. We use the treasury rate just to get comparability across time and across companies. But a dollar earned from a horseshoe company is the same as a dollar earned from an internet company in terms of the dollar. So it is not worth more based on whether it comes from somebody named .com, or somebody that named, the old-fashioned horseshoe company. So the dollars are equal, and our discount rates may reflect different expectations about future streams of income, but they don't reflect any difference in terms of whether it comes from something that the market is all enthused about or otherwise. The moat and the management are part of the valuation process in that they enter into our thinking as to the degree of certainty that we attribute to the stream of income, stream of cash actually, that we expect in the future, and the amount of it. I mean, it is, it's an art in terms of valuation of businesses. The formulas get simple at the end, but if you and I were each looking at the chewing gum business, we own no Wrigley's, so I use Wrigley's fairly often in class. Pick a figure that you would expect unit growth of chewing gum, to grow in the next 10 or 20 years. Give me your expectations on how much pricing flexibility you have, how much danger there is that Wrigley's share of market is dramatically reduced. You can go through all of that. That's what we go through. That is, and in that case, we are evaluating the moat. We are evaluating the price elasticity, which interacts with the moat in certain ways. We're evaluating the likelihood of unit demand changing in the future. We're evaluating the likelihood of the management being either very bright with the cash that they develop or being very stupid with it. And all of that gets into our evaluation of what that stream of money looks like over the years. But the value of how the investment works out depends on how that stream develops over the next 10 or 20 years. We had a question earlier today that made certain suppositions about what could happen at Berkshire, and the formulation was exactly right. The question of what numbers to use is another question, but the formulation was proper, and that formulation, the moat enters into that. If you have a strong, big enough moat, you don't need as much management. It gets back to Peter Lynch's remark that he likes to buy a business that's so good that an idiot can run it because sooner or later one will. Well, he was saying the same thing. He was saying that what he really likes is a business with a terrific moat where nothing can happen to the moat. And there aren't very many businesses like that. But then, so you get involved in evaluating all these shadings. This, not the cherry version, but the regular version, this one has a terrific moat around it. There's a moat even in this, in the container. There was some study made as to what percentage of the people could identify blindfolded what product they were holding just by grabbing the container. And there aren't many that could score like Coca-Cola in that respect. So here you've got a case where that product has a share of mind. There's 6 billion people in the world. I don't know what percentage of them have something in their mind that's favorable about Coca-Cola, but it would be a huge number. And the question is, 10 years from now, is that number even larger? And is the impression just a slight bit more favorable on average for those billions of people that have it? And that's what the business is all about. If that develops in that manner, you've got a great business. I think it's very likely to develop in that manner, but that's my own judgment. I think it is a huge moat at Coca-Cola. I think it varies by different parts of the world and all of that, and I think on top of it, it has a terrific management. But there's no formula that gives you that precisely, that says that the moat is 28 feet wide and 16 feet deep, or anything of the sort. You have to understand the businesses, and that's what drives the academics crazy, because they know how to calculate standard deviations and all kinds of things, but that doesn't tell them anything. And what really tells you something is if you know how to figure out how wide the moat is and whether it's likely to widen further or shrink on you. Charlie?
Well, you aren't sufficiently critical of the academic approach. The academic approach to portfolio management, corporate finance, et cetera, is very interesting. It's a lot like long-term capital management. How can people so smart do such silly things? And yet that's the way it is.
That's the great book that needs to be written, really, is, why do smart people do dumb things? And it's terribly important because we've got a lot of smart people working with us, and if we can just exercise all the dumb things, it's just amazing what will happen. And to some extent, the record of Berkshire, to the extent it's been good, has been because not because we've done brilliant things, but we've probably done fewer dumb things than most people. But why smart people do things that are against their self-interest is really puzzling. Charlie, tell me why.
Well, you could argue that the very worst of the academic inanity is in the liberal arts departments of the great universities. And there, if you ask the question, what one frame of mind is likely to do an individual the most damage to his happiness, to his contribution to others, what one frame of mind will be the worst? And the answer would be some sort of paranoid self-pity. Couldn't imagine a more destructive frame of mind. Now you got whole departments that want everyone to feel a victim. And you pay money to send your children to places where this is what they teach them. It's amazing how these pockets of irrationality creep into these eminent places. One of the reasons I like the Berkshire meetings is I find fewer of those silly people.
He excluded the head table from that. Zone 2.
My name is Gaylord Hanson. I'm from Santa Barbara, California. And I'm a rookie as an investor with Berkshire Hathaway because I only started investing last November. And if this is a typical annual meeting, I will be here every first Monday of May the rest of my life.
And we'll be glad to have you. Thanks.
Now, I'm very proud to have finally uncovered Berkshire Hathaway and am an investor. But I may have made a slight error in which issue to buy, A or B. I watch my investments rather closely, and I do believe in buying and holding. I don't buy and trade at all. I've got things I bought 10, 15 years ago, and I still haven't, and I've made a lot of money. But I make an analysis every December 31st on my portfolio, and I looked at Hathaway A, and I looked at Hathaway B on January 1st, and again on the 23rd of April. Hathaway A was up 10% since January 1st. Hathaway B was 5.3%. Now, I don't like that. Now, I must confess that I'm not inclined to buy a $77,000 stock and buy 1 or 5 or 10 shares. But in this instance, because I bought a fair little bit of it, I bought the B, and my increase in value per share is 4.7% less in B than in A, and I got to have that explained to me by Mr. Buffett.
Okay.
I have one further comment. You mentioned the 30 times the B being an A value. Well, if I multiply the value on the 23rd of April of $2,474 per share by 30, I come up with $74,220, but the price of A was $77,000. Now, I want to know whether I'm stupid or some good, intelligent answer from Mr. Buffett.
Okay. If you'll read what we've got, both in the original offering on the B as well as on the website explaining everything, the A can always be converted into 30 shares of B. So it can't sell for anything other than a very tiny amount less than 30 shares of B. And if it went below that, arbitrage would occur. But it doesn't convert the other way. So there's no question that whereas a share of B can never be worth more than about 1/30th of A, it can be worth less because the conversion doesn't run the other way. Now, at year end, I didn't look at the prices, but obviously the A and B were at almost parity, or probably at parity from what you say. And at that level, we say that if you're buying at least 30 shares of B, you're better off buying the A, because you can always convert it into 30 shares of B, and without having paid any premium, you can't lose money, and you can gain money if the B goes to a discount. The B will periodically go to a discount against the A. It depends on the supply and demand of the two securities. The B will not go to a premium above the A of any significant amount, because then conversion occurs, and we've had a lot of conversion occur. I have personally said on the website, for example, that I think when the B is at more than a 2% discount, I would rather buy the B if it was me. But if it's at less than a 2% discount, I'd probably buy the A, because I just think that you've always got the right to go one direction and you don't have the right to go the other direction. I would predict, as I think I did just a little earlier, that if you take the next 10 years, you're going to find a significant number of months when the two stocks trade at parity at 30-to-1 relationship, and you're going to find a significant number of months when the B sells at a discount. When people who are buying smaller amounts are the more aggressive buyers of the stock, they will push the B up to the point where A gets converted into B, and that means that the B is selling at a very slight premium over the A. And when you find times when people are on balance preferring their larger buyers, maybe institutional buyers, then the A will tend to sell at some premium. I think you may have picked on April 23rd. My guess is it's narrowed a little bit, because I think it's a 3 and a fraction percent discount at the moment. But I would sort of use that guideline I stuck on the website, although there's nothing magical about it. Those will be the prevailing facts. I mean, if the B is selling at 2,500 and the A is selling at 75,000, a 30-to-1 relationship, and you are buying at least $75,000 worth of stock, I advise you to buy the A, because the next day, if you wanted to, you could convert it into 30 shares of B. But you can't buy 30 shares of B and convert it into 1 share of A. So I'm not sure on the day you actually bought, if you bought B, it sounds as if you did. On the day that you actually bought B, I don't know whether you were buying it at a discount or not. Most of the time last year, it did not sell at a discount. Most of the time this year, it has sold at a discount. There will be times when it will sell at parity, and there will be times when it sells at a discount. Charlie?
Yeah, when you made your original decision to buy the lower priced of the two stocks, you made a mistake.
Well, if he was buying at least 30 shares.
Yeah. If you were buying at least 30 shares. And now that the B stock is down to such a discount versus the A, Warren is saying he would hold the B. What could be simpler?
Mm-hmm. We'll try and make both the A and B work out fine. But you should understand the relationship of the two, and we tried to be extremely clear about that when we brought out. We had a page which we devoted precisely to that point, and I put this thing up on the website because I was getting some mail that was questioning. People clearly didn't understand it, so I put this up on the website, and if you click on our home page, you will see some reference to something else you can click that says the relative situation on the A and B, and I hope it's clear. Zone 3.
Hi, my name is John Liu from New York City. First, let me start out by thanking both of you for the incredible education that you've provided me through your annual reports and the various presentations that you've given in public and in publication. I was about to send you my tuition check last week, but instead I decided to buy more shares of your company. I hope you'll forgive me.
No, you learned well.
My question basically centers around the insurance industry at present. Right now, there's excess capacity, which comes and goes, typically speaking, but there seems to be a trend towards international consolidation, and also there seems to be a trend towards demutualization in the life insurance companies in the U.S. I was wondering if you could give us your thoughts on what the future face of the insurance industry will look like.
Yeah, both of those trends do exist that you talked about. I don't think that consolidation usually solves many problems. I mean, if you have two lousy businesses and you put them together, you got a big lousy business usually. And I am not a big fan of consolidation where the theory is that you really have two very mediocre businesses and you're going to wring the costs out of one, and it just doesn't work that way in my experience. But the consolidation will go on, and the demutualization of life companies will go on. It's not inconceivable that we would play some part in one or the other in some way, although it's not high on our list. But I've learned in this business never to say never, because things do happen that cause me to want to retract some earlier statements. The winners are going to be the people that have some franchise based on specialized talents, on terrific distribution systems, managerial know-how, even the ability to use the float effectively, and in the case of something like GEICO, on the superior, it's combined with the franchise, a superior distribution system. I mean, we have the low-cost method of distributing personal auto insurance on an all-comers basis. USAA does a terrific job of delivering low-cost insurance to a specialized group. GEICO actually came out of USAA. And Leo Goodwin and his wife Lillian, who founded the company in 1936, were both employed by USAA, and Leo, as I remember, was an officer of the company. So the idea of GEICO came out of a USAA, but they've limited to a given class. We offer it to everybody in the country, except we can't offer it in New Jersey or Massachusetts because we can't figure out any way to make any money there. 20th Century's done a terrific job of becoming a low-cost operator in a given urban area in the greater Los Angeles area. But in terms of an all-comers, all-geography, all-occupation type operation, in my view, GEICO is the best operation in the United States, and better yet, consumers around the world are agreeing, or around the country are agreeing with that view. GEICO gained last year 20.8% policyholders. This year, in the 12 months ended March 31st, it's up 22.5% policyholders. These are on big numbers, the base, and the growth has accelerated. So that sort of an advantage will make for a very good insurance business over time. I think the average insurance company is going to remain very average, and there is a lot of capital in the industry, as you pointed out. There's more capital in the industry than there is opportunity to use it intelligently, and nevertheless, it doesn't go away. You are not seeing consolidation that takes away a lot of the capital of the industry. You're not seeing massive or anything of the sort. So the capital is there. It's seeking an outlet in premium volume. That actually hurts a General Re to an extent, because it means that the primary companies want to retain more of the premium they generate just so they can show some kind of growth against this capital base. I think generally we're very well positioned in the industry. I think the industry will be tougher in the next few years by a significant margin in the personal auto business. But frankly, I look forward to it, because I think it may offer us the opportunity to grow even faster. We have the best vehicle in a very, very big industry, the auto insurance business, and we've got incredibly good management to take advantage of that, and we've got policies available as you leave the door. Charlie?
Nothing to add.
Zone 4.
Good afternoon, and thank you. My name is Paul Worth. I'm from Wichita, Kansas, and my question is as follows. For the consumer franchise companies that Berkshire owns, Coca-Cola and Gillette in particular, in which emerging markets do you see the greatest 10-year potential for unit sales growth, and what economic, political, or social changes are precipitating that growth? Secondly, do you believe that the U.S. market cap as a percent of the world's at 53% is near its zenith, and which countries do you believe will likely show the greatest percent growth in total market cap?
Well, I wish I had the answers. The first question, though, obviously, when you're dealing with something like Coke is raw numbers. I mean, there's huge potential in a country, with the largest country in the world, in China, where the per capita consumption is very low, but is growing very fast. So it's very easy for me to predict, and probably be right, absent some tremendous upheaval or some real surprise, that China would be the fastest growth market among countries of any size in the world for Coke from this level. But that's based on the fact that you just got a huge number of people that clearly like the product, that are starting from a very low base, and where a lot more bottling infrastructure is going to be needed, but which will be supplied to facilitate that growth. With Gillette, it's a little different. And people are already shaving. What you do is you upgrade the shaving experience that they have. So you have great differences in the quality of the blades available, great differences in the quality of the blades available from shaving systems when you get into the more advanced ones. And they trade up, and they get a much more enjoyable shaving experience. They get better shaves than was the case when they were forced to rely on the lowest priced product. But both of those companies have tremendous opportunities as the prosperity around the world, as the standard of living grows, and there's just no doubt in my mind that in the blade and razor business for Gillette, which is only a third of their business, but here's and all of that sort of thing, but I would almost guarantee you that 10 or 20 years from now, both of those companies will be doing a lot more business in those areas I named than currently. And we don't fine tune it a lot more than that. I mean, I do not sit and try and work out country by country what's going to happen with a Gillette or Coke. It would be a waste of time. I wouldn't know the answer anyway. But I'm pretty sure of the conclusion that both of them will prosper a great deal. And I would hate to be competing with either one of them here or anywhere else in the world. I mean, they have the winning hand. Charlie?
Well, I'd agree with everything you said, and I'd like to add that if I knew for sure that the United States share of worldwide market capitalization was going to go from 53% down to 40%, I wouldn't know how to make money out of that insight by running around buying foreign securities.
Yeah, we just don't operate on that basis. And I mean, a few years ago, emerging markets were all the rage, and every institution in the country was getting promoted by somebody who said, I'm going to run an emerging markets fund, and they felt they had to participate in it, and their advisors told them they had to participate. We regard that all as nonsense. In the end, you just have to think for yourself about what you know and what you don't know, and go where that leads you. And you don't do it by buying into things with names on them, or sectors, or country funds, or that stuff. That's merchandise that's designed to sell to people, and it usually is sold to people at the wrong time.
Yeah. Our game is to find a few intelligent things to do. It's not to stay up on every damn thing that's going on in the whole world.
Yeah. Zone 5.
Hello, my name is Everett Puri. I'm from Atlanta, Georgia, and I've two questions. One is for Mr. Munger in our never-ending effort to have the Munger books. The second is, it seems that with the pharmaceutical industry earlier, that the threat of government regulation or government appropriation of those cash flows led to a reasonable market opportunity. And the same thing with Sallie Mae. And I'm wondering if you feel that that's going on with the tobacco industry now, or if that is a larger threat to that industry, larger and permanent threat.
Well, number one, the books. Hagstrom sent me chapters of his latest book on Warren Buffett called The Buffett Portfolio, and I didn't read them because I thought his first book was a respectable book but didn't contribute too much to human knowledge. And at any rate, he sent me the second book, a full version, and I read it, and I was flabbergasted to find it not only very well written, but a considerable contribution to the synthesis of Hagstrom's second Buffett book. I noticed the airport was heavily promoting it, and it's called the Warren Buffett Portfolio. It doesn't pick any stocks for you, and it's called the Warren Buffett Portfolio. It doesn't pick any stocks for you rationally. Another book that I liked very much this year was Titan, the biography of the original John D. Rockefeller. Titan, the biography of the original John D. Rockefeller. Business biographies I have ever. That is just a wonderful, wonderful book, and I don't know anybody who's read it who hasn't enjoyed it. So I would certainly recommend that latest biography of John D. Rockefeller I. The third book is sort of a revisitation of the subject matter of the book I recommended a year or two ago called Guns, Germs, and Steel, which was a physiologist's view of the economic history of man. And it was a wonderful book. And much of that same territory has now been covered by an emeritus history professor from Harvard who just knows way more economics and science than is common for a history professor, and that gives him better insight. And his book is a takeoff in title on Adam Smith, and the title is The Wealth and Poverty. His book is a takeoff in title on Adam Smith, and the title is The Wealth and Poverty, and the guy's name is Landis. So I would heartily recommend the
tobacco and pharmaceuticals.
Oh, tobacco. Mm-hmm. I don't know about Warren, but I think the legislative threat to tobacco is serious, and I haven't the faintest idea of how to predict it.
Yeah, I would say that there's no comparison between the threat to tobacco currently with the threat to pharmaceuticals in 1993, that the problems of the tobacco companies are of a far different order than the problems of the pharmaceutical companies. Nobody was against pharmaceuticals. They were just distribution and all of that. But tobacco's a different story. So, I mean, tobacco companies, well, you can figure it out for yourself. In terms of books, I would recommend. Many of you may have read it, but this goes back more than a year. But I would, if you haven't read Katharine Graham's autobiography, it is one terrific book. It's a very incredibly honest book, and it's a fascinating story. I mean, it's a life that's seen all kinds of things in politics and in business and in government. It's a great read. A book that came out just in the last few months in the investment world that I would certainly recommend everybody is Common Sense on Mutual Funds by Jack Bogle. Jack is an honest guy, and he knows the business. It's by Jack Bogle. Jack is an honest guy, and he knows the business, billions of dollars a year. And he asked me for a blurb on the book, and I was delighted to provide it. Let's go to Zone 6, please.
Good afternoon, Mr. Buffett, and good afternoon, Mr. Munger. My name is Monish Pabrai, and I'm from the Chicago area. My name is Monish Pabrai, and I'm from the Chicago area. You may, at the pace at which you answer my letters, point by point. I have a question for you related to circle of competence. I have a notion that both Mr. Munger and yourself understand the Kleiner-Perkins model of early stage venture capital investing, and currently they're focused in the internet space extremely well. My notion is that I think it is well within your circle of competence to understand what they do, just like you understand what your managers at See's Candy or Executive Jets do. So the question is that with the internet, I think we're seeing a change that has not been seen in the last 500 years as humans. We haven't seen something that is as dramatic and as profound that's going to come upon us. If, let's say, a John Doerr at Kleiner-Perkins approached you and said that they were starting, let's say, $1 billion early stage or later stage internet investment fund that Kleiner would manage, would you consider that, would you consider participating in that investment to be within your circle of competence if it were offered at terms that looked attractive?
I agree with the first part of what you said. I mean, I'm not sure that it'll necessarily will be the most important thing in the last 500 years in the commercial world, but it could well be, and if it isn't, it's right up the most important thing in the last 500 years in the commercial world, but it could well be, and if it isn't, it's right up the development. But and I would say that Charlie and I both understand the process of early investment / promotion probably as well as anyone. We haven't participated in it. There are certain things we don't even like about it, but we do understand it, right, Charlie? And I would say that no, we would not have an interest in investing in the fund. We do not necessarily regard the internet. There's no question, if you're in the early stages of promotion, and particularly if you've got a reputation as successful in that, but in this case it wouldn't make much difference because the whole field has gone wild, you will make a lot of money selling to the next stage and the next stage and the next stage. But in terms of picking out businesses that are going to do wonderfully as businesses, not as stocks for a while, but as businesses, I don't think it's necessarily so easy in the internet world. And I would say that if you were to ask some very top names in the field to name the next 5 companies out of the chute, or the next 10 companies out of the chute, and predict that one of them will earn, say, the $200 million I used as a threshold 6 or 7 years from now, I'm not so sure if they gave you a list that they would name a single one. That doesn't mean they might not make a lot of money by being early investors in them because they sell out to the next group and so on. But in the end, they have to succeed as businesses. And if few will succeed as businesses, the internet will have a huge impact on the world. But I'm not so sure that makes it an easy investment decision. Charlie?
Well, at least it's not an easy investment decision for us. And that's what we're looking for.
Yeah. We will never turn our money over to somebody else. If we're going to lose your money as Berkshire shareholders, we're going to lose it ourselves, and we're going to come back and look you in the eye and tell you how we lost it. We are not going to say this game is too tough, so we'll give our money to somebody else. You can give your money to somebody else, and you're tough, so we'll give our money to somebody else. You can give your money to somebody else, and you don't need the intermediaries. All the time, I had a call within the last couple of days on something you would know very well about participating in some fund. Or they always have, it's always stage 1, stage 2, stage 3, and the idea is we get some more people to come in later at twice the price, and maybe the fact that our name is, involved in it will cause people to pay even more. Turn the money over to someone else to manage. It's your money. You gave it to us to manage. We'll manage it. If you decide you don't want us to manage it, you decide who you give it to. We're not going to be intermediaries on it. And if we don't understand something ourselves, we're not looking for anybody else to do it for us. The world doesn't work very well that way anyway. I mean, usually you end up in the hands of the promoter. The world doesn't work very well that way anyway. I mean, usually you end up in the hands of the promoters and not the hands of the people who really know how to make money. Charlie? Okay, Zone 7.
Good afternoon, Warren, Charlie.
Hi, Peter.
Good to see you. I'd like to ask you what your thought process was when or share with us your thoughts when you decided to sell McDonald's.
That must have been Charlie's idea, Peter. Peter, incidentally, is in a family that 4 generations have essentially invested with us, and they're all terrific people, I might add. His dad was a wonderful guy. I said it was a mistake to sell it, and it was a mistake, and I just reported that in the interest of candor, and there were some reasons why I thought it was something I didn't think obviously that it was any great short sale or even a great sale, but I didn't think it belonged in the list of 8 or 10 of the businesses, of the very few businesses that we want to own in the world. And I would say that that particular decision has cost you in the area of $1 billion plus. Charlie?
You want me to rub your nose in it? You're doing a pretty good job by yourself. By the way, that's a good practice around Berkshire. We do rub our own noses in it. We don't even need the help of the Kenters.
We believe in postmortems at Berkshire. I mean, we really do believe. One of the things I used to do when I ran the partnership was I contrasted all sale decisions versus all purchase decisions. It wasn't enough that the purchase decisions worked out well. They had to work out better than the sale decisions. And managers tend to be reluctant to look at the results of the capital projects or the acquisitions that they propose with great detail a year or two earlier to a board, and they don't want to actually stick the figures up there as to how the reality worked out against the projections. And that's human nature. But I think you're a better doctor if you drop by the pathology department occasionally, and I think you're a better manager or investor if you look at every one of the decisions you've made of importance and see which ones worked out and which ones didn't, and what is your batting average. And if your batting average gets too bad, you better handle the decision making over to someone else. Charlie, you want to rub my nose anymore?
No.
No, that's okay. Okay, we're Zone 8.
Good afternoon. Ian Sachs from New York City. This afternoon, through various questions and comments, we've mentioned the fact that the word trust, which Berkshire Hathaway and the brand has, we've mentioned basically health and the importance of health and that being above everything else. With Berkshire's competencies in the insurance industry and with the healthcare services sector being relatively depressed, although the dynamics would be different in the industry, how risk is managed on an overall basis, has Berkshire looked at all in terms of taking a position or buying a health insurance business?
Charlie runs a hospital, so I'm going to let him talk about this.
Sure, we've looked a little. We look at everything in turmoil that's important in the world. But so far, it hasn't seemed to yield our particular mental approach.
Yeah, I don't know who I would want to get in with in that business at the moment. That's not. not condemning the people in the business. It just means I don't know. I haven't been able to evaluate that, and I think it would make an enormous difference in terms of you want to get in with a quality operation and quality people and at a sensible price, and quality operation and quality people and at a sensible price, and
significance of slock operators in the field who are painting the reality different than it is. That makes it harder.
Zone 1.
Eric Tweedy from Shavertown, Pennsylvania. I just wanted to express our appreciation regarding all the operating businesses that we've visited. They've been very warm and hospitable. In fact, when we visited executive jets at the airport, the tour was so impressive, my wife wanted to buy an airplane.
What's her name? What's her name?
Well, I won't say that. But American Express declined the $500,000 we tried to put in my card. You can thank the chairman for me next time you see him. Just kidding. But my question regards basically approach to investing. I've been investing my own money in equities for about 10 years, and my results overall have been relatively good. In the process, however, I've taught myself some very painful and costly lessons. For instance, my first equity I ever purchased was a share of Berkshire Hathaway for $5,500 in 1990, and I sold it 3 months later for something over $8,000 and congratulated myself for the rapid and shrewd profit. And earlier this year, I repurchased the same share for $70,000, and I intend to own it for the rest of my life. So you can see I'm growing. My question is, I have no formal education in accounting and finance, and I would just like some advice from you regarding an approach to educate myself in a reading list of basic texts, obviously starting with the Berkshire Hathaway annual reports. Thank you.
Thank you particularly for your comments about the people from our operating companies, because they have just been terrific. They come out here, you know, they are here at 5 in the morning. They do a tremendous amount of work over this weekend. They're cheerful. I've met with them all on Saturday at lunch, and they're just one sensational group of people, and I'm very proud of them, and the managers should be very proud of the people they've brought with us, and I hope you get a chance to thank as many of them as possible personally. Incidentally, at the C's counter, you'll find Angelica Stoner, who's been with us for 50 years, and here she comes from California to help us out and sell peanut brittle, and she's having a good time doing it. And the question you ask is a very good one about, in terms of accounting and finance, what's the best way to teach yourself? I was always so interested in it from such a young age that my approach was to go to the Omaha Public Library and just take out every book there was on the subject. And I learned a lot. I learned a lot that wasn't true in the process too. I got very interested in charting and all that sort of thing and buying stocks. But I did it by just a tremendous amount of reading. But it was easy for me because it was like going to baseball games or something of the sort. And in terms of naming specific texts in accounting, and I think you may want to read some of the better, even magazine articles that have appeared. There've been or newspaper articles. There've been some good commentary about accounting there. I don't have. Can you think, Charlie, of any specific texts or anything that we could recommend?
I think both of us learn more from the great business magazines than we do anywhere else. More from the great business magazines than we do anywhere else. It's just to riffle through issue after issue after issue, covering a great variety of businesses. And if you get the mental habit of relating what you're reading to the basic structure of the underlying ideas being demonstrated, you gradually accumulate some wisdom about investing. I don't think you can get to be a really good investor over a broad range without doing a massive amount of reading. I don't think there's any one book that will do it for you.
Yeah. You might think about picking out 5 or 10 companies where you feel quite familiar with their products, maybe, but not necessarily so familiar with their financials and all of that. But pick out something so at least you understand if you understand their products, you know what's going on in the business itself, and then get lots of annual reports and through the internet or something else, get all the magazine articles that have been written on those companies for 5 or 10 years. Just sort of immerse yourself as if you were either going to work for the company or they'd hired you as the CEO or you were going to buy the whole business. I mean, you can look at it in any of those ways. And when you get all through, ask yourself, what do I not know that I need to know? And back many years ago, I would go around and I would talk to competitors always. You'd talk to employees of the company and ask those kind of questions. That's in effect what I did with my friend Lorimer Davidson when I first met him at GEICO, except I started from ground zero. But I just kept asking him questions. And that's what it really is. One of the questions I would ask, if I were interested in the ABC company, I would go to the XYZ company and try and learn a lot about it. Now, there's spin on what you get, but you learn to discern that. Essentially, you're being a reporter. I mean, it's very much like journalism. And if you ask enough questions, Andy Grove has in his book, he talks about the silver bullet. You talk to the competitor and you say, if you had a silver bullet and you could only put it through the head of one of your competitors, which one would it be and why? Well, you'll learn a lot if you ask questions like that over time. And you ask somebody in the XYZ industry and you say, if you're going to go away for 10 years and you had to put all of your money into one of your competitors, the stock of one of your competitors, not your own, which one would it be and why? Just keep asking and asking and asking. And you'll have to discount the answers you get in certain ways, but you will be getting things poured into your head that then you can use to reformulate and do your own thinking about why you evaluate this business at this or that. The accounting, you just sort of have to labor your way through that. You may be able to take some courses even in that. But the biggest thing is to find out how businesses operate. And, who am I afraid of? If we're running GEICO, who do we worry about? Why do we worry about them? Who would we like to put that silver bullet through? I'm not going to tell you. That you keep asking those questions, and then you go to the guy they want to put the silver bullet through and find out who he wants to put the silver bullet through. It's like who wakes up the bugler, in the Irving Berlin song. And that's the way you approach it. And you'll be learning all the time. You can talk to current employees, ex-employees, vendors, suppliers, distributors, retailers. I mean, there's customers, all kinds of people, and you'll learn. But it's an investigative process. It's a journalistic process, and in the end, you want to write the story. I mean, you're doing a journalistic enterprise, and 6 months later, you want to say, the XYZ company is worth this amount because, and you just start in and write the story. And some companies are easy to write stories about, and other companies are much tougher to write stories about. We try to look for the ones that are easy. Charlie?
Yeah. For the histories of the 1,000 biggest corporations laid out in digest form, I think Value Line is in a class by itself. That one volume really tells a lot about the histories of our best companies.
Yeah, if you just look, there's 1,700 of them. If you look at each page and you look at sort of what's happened in terms of return on equity, in terms of sales growth, profit margin, all kinds of things, and then you say, why did this happen? Who let it happen? What's that chart going to look like the next 10 years? Because that's what you're really trying to figure out. Not the price chart, but the chart about business operation. You're trying to print the next 10 years of Value Line in your head. And there's some companies that you can do a reasonable job with, and there's others that are just too tough. But that's what the game is about. And it can be a lot of, if you have some predilection toward it, it can be a lot of fun. The process is as much fun as the conclusion that you come to.
Of course, what he's saying there, when he talks about why, that's the most important question of all, and it doesn't apply just to investment, it applies to the whole human experience. If you want to get smart, the question you got to keep asking is why? Why? And you have to relate the answers to a structure of deep theory. And you got to know the main theories. And it's mildly laborious, but it's also a lot of fun.
Zone 2.
Good afternoon, Mr. Buffett and Mr. Munger. I'm Patrick Wolf, formerly from Cambridge, Massachusetts, and soon to be from the San Francisco area. Like many people around the world who want to learn about business, I've read all of your letters to the shareholders, and like many people here in this room, I was so impressed that I bought a piece of the company. But I must admit that in studying Berkshire Hathaway, there's one element that I didn't quite understand, and I'd love it if you could please explain it. And that is the following. How does Berkshire Hathaway add value to the various wholly owned companies in the manufacturing, services, and retail division? And the reason I ask this question is, as you yourself said earlier this morning, it's very difficult in a negotiated purchase agreement to buy a company for anything other than what it's truly worth. So if Berkshire Hathaway is going to create value by buying such fantastic companies as the Nebraska Furniture Mart or See's Candies or any of the other fantastic businesses we have, there must be some way in which Berkshire Hathaway adds to that value. Could you please explain how we do that?
In certain specific cases, case of General Re being the most, why we thought there was at least a reasonable chance that the ownership by Berkshire would add value, and we got into various reasons about the ability to use the tax advantage, float and tax advantages, and the ability to move faster around the world, and that's we've actually spelled out in that case. I think in the case of something like Executive Jet, you might well figure that there are some reasons why association with Berkshire would put Executive Jet on the map and in the minds of people who could afford to buy fractional ownerships of planes faster than might otherwise be the case. But usually the situation, so there are specific cases where we bring something to the party, but the biggest thing we bring to the party on a generalized basis is what I spelled out a little bit in the annual report this year in talking about GEICO. We enable terrific managers to spend, in many cases, to spend even a greater percentage of their time and energies on what they do best and what they like, to spend even a greater percentage of their time and energies on what they do best and what they like with our ownership. In other words, we give them a very rational owner who expects them to spend all of their time focused on what counts for the business and eliminates the distractions that often come with running a business, particularly a publicly owned business. I would guess that the CEOs of most public companies waste a third of their time at least in all kinds of things they do that really don't add a thing to the business. In many cases subtract, because they're trying to please various constituencies and waste their time with them that take the company backwards. But we eliminate all of that. So we simply can create an ownership. We think we can create the best ownership environment, frankly, that can exist other than maybe owning it 100% yourself for any business. And that happens to also go along with how we like to lead our lives, because we don't want to run around and attend a lot of meetings and do all of these things that people do. And that can be a significant plus. I think that GEICO has probably grown a fair amount faster as a subsidiary of Berkshire than it would have if it remained an independent company, although it was a hell of an independent company, and would have continued to be one. But I think to the value of GEICO over and above what would have happened if it had remained a public company. Not because, as I put in the report, now we haven't taught the management one thing about the classification of insurance risks or how to run better ads or anything of the sort. We've just let them spend 100% of their time focused on what counts, or anything of the sort. We've just let them spend 100% of their time focused on what counts.
Just not having a vast headquarters staff to tell the subsidiaries what to do, that helps most of the kind of subsidiaries that we buy. They are not looking for a lot of people looking over their shoulder from headquarters and a lot of unnecessary flights back and forth and so on. So I would say most of what we do, or at least a great part of what we do, is just not interfere in a counterproductive way. And that non-interference has enormous value, at least with the kind of managers and the kind of businesses that have joined us.
In a great many, you have to see it to believe it, but in a great many corporate operations, the importance of a large group of people is tied to how much they meddle in the affairs of other people who are out there doing the work. And, we stay out of the way. And we're appreciative owners, and we're knowledgeable owners. We know when somebody has done a good job, and we're knowledgeable owners. We know when somebody has done a good job, and we know when they've done a good job when industry conditions are terrible. Two operations, for example, and they are in tough industry conditions now. We've got some absolutely terrific people, and we are knowledgeable enough about that so that we don't go simply by a bunch of figures and make a determination whether people are doing the right thing. So we're knowledgeable owners, and we have no one whose job at headquarters is to go around and tell our managers how to run their human relations. Not only do people have more time to work on the productive things, but I think they probably actually appreciate the fact that they're left alone. So I think you even get more than the proportional amount of effort out of them than would be indicated simply by the amount of time you free up, because I think you get an added enthusiasm for the job. And I think having people in a large organization that truly are enthusiastic about what they're doing, that doesn't happen all the time. But I think it does happen to a pretty good degree at Berkshire. Charlie? Yeah.
No more.
Okay. Zone 3.
Chairman, hi, I'm David Butler from here in Omaha. A comment and then two quick questions. The comment is regarding the annual reports. I read a lot of annual reports for a living, and I sort of start off with the assumption that I'm going to have to spend 20 to 30 hours looking at 5 years of 10Ks and 5 years of annuals, probably some 10Qs, and gronk through a lot of numbers to have any kind of idea how the company really is working. And comparing that to Berkshire, which has basically crystal clear clarity, it's quite refreshing to read honesty, and it's quite refreshing to see accounting that's actually presented in a clear fashion and that doesn't try to hide facts. So as a shareholder and as an investor, I'm very grateful for the effort and for the high quality of your annual report, and I think we ought to give Mr. Buffett and Mr. Munger a hand for that. Thank you. Okay, now that I've brown-nosed a little bit.
Here comes the zinger, huh?
Yeah. I'm nervous about the derivative operations that General Re has. Now, right now, the balance sheet figure says that there's a $400 million net asset position, but there are also some really hairy derivatives, the swaps and the floors and caps. And knowing that in the past you haven't used those types of leveraged derivatives, I'm wondering if that's going to change now. And then secondly, in terms of going through an intrinsic value calculation, when you and Mr. Munger think about intrinsic value, obviously a big part of that is the marketable securities portfolio. Do you think of intrinsic value in terms of the marketable securities as what their market value is, as in terms of their look-through earnings, or is there a separate intrinsic value calculation that you sort of roll into the overall Berkshire intrinsic calculation?
Yeah, I'll answer the second part first. On the intrinsic value, we tend to use the market prices in the way we think about things, although there are times when we feel that we own securities that are worth far more than they're carried for. And we've mentioned that once or twice. There was a time in the mid-1970s, if you look back at our 1975 annual report, I may be off by a year, one direction or other, probably 1974, because we valued the securities at market, but in the body of the report, I said, we really think these things are going to be worth a hell of a lot more than they're selling for currently. That was an unusual remark for somebody. If you knew me, that would be an unusual remark for me. And at that time, I would have said that in looking at the intrinsic value of Berkshire, I would have said that I was quite comfortable marking these things up in my mind. I wouldn't have done it with the public, but I would have done it in my mind. But under most circumstances, we tend to think of the market value as being representative of it, because that is the price at which we could buy or sell that day. And if we thought they were ridiculously high in relation to intrinsic value, we'd probably do something about it. And they certainly haven't been so low that we've ever felt like marking them up in our own minds in recent years. The question about the derivatives business is a good business. It's a good question because it involves big balance sheet numbers and big off-balance sheet numbers in relation to the amount of money made, and particularly in relation to the amount of money made in terms of the capital employed and the credit guarantees, the long-term nature. All of that makes that something that we do want to look at always very hard. It's a business that people can get in trouble in, and they can get in trouble while the accounting sails along merrily. I remember when Charlie and I were at Solomon, we didn't find it, other people found it finally, but mismarked derivative positions that were very substantial that had gone on for a long time. Am I right about that, Charlie, on that? Charlie was on the audit committee.
The worst glitches were that the books just got so out of control, not in the derivative department, that there were just multi-million-dollar errors.
But we found mismarks, as I remember,
yes,
in the 20-odd millions on positions.
Yes,
and
both.
In some cases, because the contracts got so complicated that the people that were valuing them didn't understand them, and at least partially didn't understand them. I mean, there's a lot of potential for mischief when people can write down a few numbers on a piece of paper and nothing changes hands for a long time, and their compensation, next month and this year depends on what numbers are attached to a bunch of things that are not really, well, they don't come to fruition for a long time, and particularly when you're guaranteeing credit or anything of the sort. So you're very correct in observing that when the numbers are big in relation to the amount of profit, you want to look very carefully, because if anything goes wrong, it could go wrong on a fairly big scale, and you're not getting paid a lot for running that type of risk. I very much appreciate what you said about the annual report. So we may disappoint you in how the business performs. We may disappoint you in how the business performs over time. I mean, that is not totally within our control. We'll try hard, but we can make no matter of the reporting. I mean, that is in our control. We may not like what we have to tell you, but there's no reason for failure. There can be no reason for failure in the accounting or candor. I mean, that is if we fail there, it's because we set out to fail. We can fail in terms of operating performance for a lot of reasons, some within our control and some without our control. And that can happen, and if so, our control and some without our control. And that can happen, and if so, we'll tell you about it. But we're going to try very hard to make sure that you see the business, that we don't sugarcoat things, we don't put spin on things, and we'll judge ourselves to a significant degree by how we handle that particular part of the problem. We'll also try to to a significant degree by how we handle that particular part of the problem. We'll also try to do a good job in operations. Charlie, do you have anything to add on that? No. If not, it's 3:30.